I think it's pretty obvious that tech stocks are through the roof right now. If you've invested in tech stocks in the past 5 years, chances are you've made some money or a lot of money. Of course, there are some tech stocks that aren't doing too well, and there are some days in which tech stocks completely tank. But in general, tech stocks have been trending up in the past couple years, which is why after 3 major US indices, Dow Jones, S&P 500, Nasdaq has been generating the highest returns in the past couple years, because over half of Nasdaq's composition is in tech, which explains why Nasdaq has been doing so much better than Dow Jones and S&P 500 in the past 5 years. Now in Canada, there's quite a few ETFs that allows you to invest in tech. Almost all of those ETFs invest in the US tech stocks, which is understandable. I mean, some of the biggest and most valuable companies in the world are US tech companies. That being said, there is one ETF, I believe it's the only ETF in Canada or the world that invests purely on Canadian tech companies. We're talking about XIT. There's really nothing like it in the market, because you won't find another ETF that's dedicated to Canadian tech companies. Now, the Canadian stock market is dominated by industries like financials, for example, the big 5 banks, energy and utilities, telecom, TELUS, Rogers and Bell, which is quite different from the US stock market in that the Canadian stocks in general have higher dividend yields but lower growth potential. But that being said, Canada does have some tech stocks, and the major ones has been doing really well in the market, like Shopify or Constellation Software, both of which are included in the fund XIT. So let's dig into the fund. Now, the first thing that caught my eye was the MER ratio, which is 0.6%, which is really high for an ETF. The average MER ratio in Canada for ETFs is about 0.3%, so this is double that. An ETF like ZSP, which tracks the S&P 500, only has an MER ratio of 0.09%, so yeah, you get the point. I mean, in general, ETFs that invest in a specific industry, especially in tech, have a higher MER ratio. So let's look into the holdings of this ETF, and immediately I see a problem. 50% of the fund in just 2 stocks. I mean, it is the 2 biggest tech stocks in Canada with amazing growth history. And if you add up the 5 top companies in this fund, we're talking about 85% of the fund in just 5 companies. That really isn't a lot of diversification. I mean, the fund itself only has like 20 different companies invested, which is already pretty limited. So realistically, you can create like 85% of the fund yourself by buying individual stocks. And brokerages like Wealthsimple can allow you to buy fractional shares, so the ridiculously high prices of a stock like Constellation Software shouldn't be a problem. And over the past 5 years, XIT rose by about 130%. Looking at the top 5 companies in XIT, I mean, most of these companies performed better than 130% in the past 5 years. Well, I guess CGI is an exception. However, during economic uncertainties, small cap companies or smaller companies usually are a lot more volatile and perform worse than their larger cap counterparts. So if we look at some of the companies outside the top 5 holdings for XIT, it's just a bloodbath in the past 5 years, which obviously dragged down the return of this ETF in the past 5 years. I mean, it's not to say that small cap companies aren't good investments. They have a much higher upside, but in the past 5 years and into the next 5 years, global economy is gonna stay volatile, which would favor large cap companies. So in reality, XIT with 0.6% MER ratio, you're really not getting a lot of extra value there. 85% of the fund in just 5 tech stocks. You can basically create 85% of the fund without paying 0.6% management fee. And plus, the small cap companies that are in this fund, because of economic uncertainties in the next couple years, I don't see them being particularly profitable investments. Now, if you've been following my Blossom account, yes, I have Blossom now, so you can get up-to-date notifications whenever I buy and sell a stock. By by the way, this video isn't sponsored. I own about 3.3% of my portfolio in XIT, which is about $9,000, which means I'm paying about $54 annually to this fund. Obviously, that's not ideal, but why do I still keep this ETF? Because the goal of every portfolio is to keep fees low while maximizing returns. Well, the truth is, I'm just lazy. I mean, at the time, Wealthsimple didn't offer fractional shares, but I wanted in on Canadian tech stocks, and at the time, they were already expensive. So basically, I just bought XIT before Wealthsimple offered fractional shares, and I just kept it and never sold. But after this video, I'm actually gonna sell all my shares of XIT and just invest in the top 5 holdings of this fund. It saves me on fees and gets rid of small cap companies in this fund, which I believe are dragging down my returns. Again, that's not to say that small cap companies aren't good investments. We're just in a bit of a weird market situation, which I believe will continue during Trump's presidency. And look, even if Canada isn't known to have the most diverse choices for tech stocks, the top tech stocks in Canada look like pretty solid investments and can be a great addition to any portfolio. I mean, I went through the balance sheets of these 5 companies, which I won't get into in this video, but those companies have strong cash flow and is expected to do well going forward. So yeah, if you're looking to buy Canadian tech stocks, just go with the established large cap companies. History shows that they know what they're doing, especially with the fractional shares that you can buy right now with Wealthsimple. There's really no point of buying an ETF like XIT, which holds 85% of its funds in just 5 stocks. So yeah, save yourself on the management fee. Alright, that's it for today. Leave a like and subscribe if you enjoyed this video. And if you're new to the channel, I make financial tips for Canadians in my long form content and financial comedy in my shorts. With that said, thank you for watching and I'll see you next time.